and good afternoon. The presentation is provided by Accom Consultants and Company in partnership with Professional Training Institute. And if you have any questions, you could send me an email at info@professionalstraining.com, and it is at 416-913-0399. And those who have any questions, they could phone me at 416-913-0399 or 416-294-4982. Our head office is located at 100 King Street West. This is the First Canadian Place, Suite 5700, Toronto, Ontario. Now today I am going to take up this question regarding a future tax asset. Now the question is given: the ABC equipment had a carrying value of $120,000 and undepreciated cost of $90,000 as at December 31st, 2008. In July 2008, the government announced that income tax rates will go down to 25% after January 1st, 2009, and it will stay at 30% for the rest of 2008. What amount should be reported as future income taxes at December 31st, 2008? The first, you have to decide whether you are going to get a future tax asset or liability. How you can find the future tax or asset liability? Look at the carrying value. It is $120,000. Undepreciated capital cost is $90,000. So basically, if you sell the asset as of December 31st, 2008, on that particular day, there will be a $30,000 gain. Basically, when you pay taxes on a gain, it becomes the liability. Here we know there is a $30,000 gain. Whether it is going to be asset or liability, that we have to decide. Basically, it is going to be a liability. The question is whether you are going to get the future tax liability of $7,500 or the future tax liability of $9,000. I will show you how this $7,500 has been derived. It is $120,000 minus $90,000. That is basically the gain that we have. The gain that we have, and when you multiply that gain by 25%, then the 25% is going to be the tax rate, which is going to go down after January 1st, 2009. Currently in 2008, the tax rate is 30%. Now it is going down to 30%, going down. It was 30% at 2008, and it is going down to 25% after January 1st, 2009. Now this future tax liability of $9,000 was derived like this: $120,000, that the carrying value, the undepreciated capital cost is 30, and it is getting multiplied by 30%. The answer there is $9,000. Only one thing you have to remember is, when you report the future income taxes have to be reported at the rate at which these liabilities will reverse. So basically, the 25% is the right rate that should be applied to this scenario. So the answer for this question is going to be a future tax liability of $7,500. So that is going to be the answer for this question. Here, I have given you my phone number, and if you want to get more explanation on the future taxes, and I do many questions on the future taxes, so if you want to get a clear understanding, or if you are a student preparing for the CA or CGA or CMA, or if you are in the university level, you could send me an email. I could forward you the videos that I have prepared on each of the other subject matters. And thank you very much, and you have a good night. Thank you.